It is another interesting edition of the Market Review where we discuss key developments in the financial and capital market as it affects the economy. Our focus today will be on the implications of the rising tide of inflation in Nigeria on the fixed income markets. And my guest is Mr. Oluseyi Akinbi, Managing Director, Zedcap Partners Limited. Nice to have him, Mr. Oluseyi, after a while.
Morning, Otto. Nice to be here.
Yes, very well. And to all our viewers, before we begin the conversation, let us give you a wrap of key market stories from last week. The Securities and Exchange Commission of Nigeria hosted the second quarter of the Capital Market Committee webinar meeting. It was an opportunity to deliberate on the key developments in the capital market ecosystem and ways to move the market forward. It was chaired by the Director General of SEC, Mr. Lamido Yuguda. Also last week, the Nigeria Exchange Limited said it remains committed to playing a leading role in promoting corporate governance among listed companies and within the capital market ecosystem. The CEO of NGX, Mr. Temi Popola, stated this at the NBA-SBL Corporate Governance Charter launch. The launch of the Corporate Governance Charter was jointly promoted by the Nigerian Bar Association Section on Business Law, Nigeria Exchange Limited, and the Institute of Directors, Nigeria. And also last week was a busy one for the FMDQ Securities Exchange as he admitted commercial papers from the Nigerian Breweries, Mixta Real Estate PLC, and Sundry Foods under its CP issuance program. Those are some of the key stories from last week. And if you're joining us, it's the Market Review, and today we're discussing the implications of the rising tide of inflation in Nigeria on the fixed income market. My guest is Mr. Oluseyi Akinbi, Managing Director, Zedcap Partners Limited. So, Mr. Oluseyi, let's first begin with the high inflation environment. Now we're talking about 19.64% for headline inflation, and of course, food inflation is 22%, and that's really, really high trend. In the UK, as we were talking before we started this conversation, they've now hit double digits. That's 10.1% for the first time in over 4 decades. I don't know if US is going to join that double digit inflation trend. We'll monitor that. But what does this mean for the fixed income market as we see this high inflation environment in Nigeria?
The inflationary environment in Nigeria is not unique to Nigeria alone. We've seen inflation trend up aggressively across the world, from the US to the UK and to other big developed markets, right? And then the fallout, or the reason why we've seen inflation this high, has been the impact of the high liquidity injection into global economies in 2020, where the US Fed, the UK, and the European Central Bank, supported the economy by pumping in record monies into the system just to ensure that the pandemic doesn't ravage the world, right? And the impact of that was that we had a lot of money chasing to few goods, and then inflation started that trend. And then if we combine it with the impact of the Russian-Ukraine spat that has been ongoing for some few months now, right? That has also contributed to the high food prices in terms of wheat, which Russia and Ukraine contribute almost 70% of the world's supply. And then, of course, we've also seen the impact on gas prices, oil prices across the world, where oil prices are trading or have traded in the last quarter of this year at above $100 per barrel. So everything all together has, led to the high inflationary environment, and we've seen several central banks, try to raise their rates aggressively to combat this. So if we'll then narrow down into what a high inflation environment means for fixed income, it's an inverse trend in terms of prices. So what I mean is that, as inflation rises, right, anything that is fixed income loses value, right? And what we've seen across the world is that bond prices or fixed income assets have lost value, where we've seen aggressive sell-off in the markets, wherever market you want to turn to, the US Treasuries market, the Eurobonds markets, we've seen, asset prices plummet, from the highs that we saw during the pandemic. So of course, it's the direct impact of the high inflationary environment is, low bond prices. And then we've seen that also in the Nigerian market, where the CBN and the DMO, we're trying to manage rates. And then when the Central Bank of Nigeria took a turn, right, we started to see bond yields in Nigeria rise steadily. Started the year at the long end of the curve, started the year around 13%. Now we're about 14%. The short end of the curve was an average of around 11%. Now we're around 12.5, 13%. So of course, we've seen yields rise in tandem with the rise in inflation in Nigeria.
Now, let's speaking about the Central Bank of Nigeria. What's your perspective on the recent adjustment on the interest rates for interventions that is made, and how will this affect the appetite of investors in the fixed income market? They've been handling it through the COVID period, but obviously they've now signaled that it's post-COVID, so let's readjust.
Exactly. So the CBN is still. I don't think the CBN will stop its interventions across sectors or across companies or sectors that they believe are the growth sectors that can power the economy, or job expansive sectors of the economy. So the CBN has been focusing more on agriculture and manufacturing, because they believe that these are the bedrock of any economy, basically. And then the CBN has continued to support those sectors by, offering single-digit loans. The rates were around 9%. They crashed it to 5%, and then they extended the maturity also of some of these loans at the same low rates. And this is just part of CBN's idea to continually support the economy in their own way, right? Because they have this opinion that if the farmers, the manufacturers can continue to access, or the health sector can continue to access loans at very cheap rates, they will be able to expand, they'll be able to grow the economy, and the employment numbers should remain buoyant, if I may put it that way. So yes, that's part of what CBN is trying to do to support the economy, and then we see them continue on that path, right? We don't think that the CBN carrying out its development finance activities and hampering their monetary policy for now. So we believe that that's a step in the right point, and they should continue to do that to support the economy.
Okay, I mean, when the experts say that, you take it, and of course, it's a very important review. Well, let's look at investor sentiments towards the bond markets so far this year. We're in the 8th month, and of course, the federal government has been a big active player. We've seen the FGN bonds, and of course, earlier in the year, the Eurobond activities. How do you assess investor sentiments amidst all the economic challenges we are observing?
All right. So I'll break it down in two halves, right? And that has just been the story of the year. So beginning this year, right, despite the expectation, like Nigeria is in an election cycle at the moment, and part of the characteristics of a pre-election year is that you see a very bearish sentiment on Nigerian assets, where yields are expected to go up. The equities market is supposed to remain dampened, and then investors just sort of stay on the fence to see what happens. But the first half of the year was pretty different, because of majorly two things. The tax advantage of investing in treasury bills expired at the beginning of this year, right? So what that meant was that investors will need to pay an extra 10% on their interest, right, after their treasury bills matures, sort of. So that sort of made treasury bills investment extremely unattractive, and then we saw a lot of investors flock to the bond markets. So the first half of the year was largely characterized by bullish sentiment, where we saw the short end of the curve looking at it from the 2024 bond maturity to like 2028, trade around 10%, right? Just as investors, banks, asset managers needed to, protect themselves from a point of view. And they had to just, buy these bonds. So that offered them a better outlet, and of course they could save tax also. But the second half of the year has been pretty different, right? We've seen the CBN raise rates aggressively from 11.5 to 14% at the moment, right? And that what that meant was that yields across the various fixed income instruments started to go up. We saw Treasury bill yields that were around 4% at the first half of the year. We're around 7.45 at the NTB auctions. And of course, bond yields that we had at an average of around 10.65, and for the first half of the year have gone up by an average of to an average of like 12.4 at the moment. So of course, we've seen the impacts, or as the CBN, started to admit the fact that they needed to raise rates to fight inflation. We've seen the sentiment in the fixed income market also show that, where at the first half of the year, investors were likely bullish, right? And then for the second half of the year, we've seen a likely bearish sentiment because of what the CBN is doing in the market at the moment.
Yeah. So that brings me to what the projections are for Q3 and Q4. That's third quarter and fourth quarter. In terms of investors, what should they expect from the fixed income market?
So there's a very big dilemma at the moment, right? Because the federal government had set out a budget of a budget deficit of around 7 to 8 trillion naira for the year, where they actually projected to raise close to around 3 trillion from the foreign markets, basically, largely from the Eurobonds market and then from the IMF and the World Bank, right? And then since the beginning of this year, we've seen yields trend to double digits aggressively. In recent times, the Nigerian Eurobonds trended as high as 15–16%, which immediately meant that the access to the international capital market was shut out to Nigeria. So that sort of presented a dilemma where the DMO, the Debt Management Office, will need to switch, its borrowing from the international debt market, and then try to raise the additional 3 trillion naira from the local markets, right? And with what the CBN is doing at the moment, right, it has put more pressure, because of course, if I expect inflation to go up based on what are they explained, I expect yields to go higher. So what investors are actually doing at the moment is that instead of rushing to fixed income assets, right, they are holding the line, they are holding their cash, and they're trying to see how high inflation can go, because of course, as inflation goes higher, fixed income yields to tend to trend in that line. So what we expect in Q3 or to the remaining second half of the year is that we expect inflation to continue to go up, right? We expect the CBN to aggressively raise the MPR, right? They've raised the MPR already by around 250 basis points this year. So we expect them to, raise it by another 100 basis points, just in line with what is happening around the world, right? Inflation is 19.6. We're already, this is the highest we've seen since 2004, 2005. So there's really record setting at this moment. So of course, the CBN will come out aggressively, trying to tighten market liquidity. And what that means is that, yields will continue to trend up. But historically, there've been some support around the markets when we have this type of downturn. So what we expect is that, between in the bond markets, when yields tend to touch between 14 to 16%, investors tend to start getting comfortable, right? We cannot really say if this time is different, because a lot of things are happening. The inflation are getting to high levels. Nigeria cannot tap the international debt market again. So there are a lot of things that are happening uniquely in the Nigerian market. But of course, we think that as yields tend to trend towards 16%, we expect investors' appetite to come back. But before then, between now and let's say October, we expect yields to trend much more higher, maybe about 100 to 150 basis points from where we are at the moment. So just to recap, the summary is that the markets will remain bearish in the next 2 to 3 months. And then we expect investors to start to reinvest as soon as the yields get to historically high levels.
We can't wait for the market to get back to historical high levels so that it move from bearish to bullish, because that's where everyone wants it to be. Thank you very much for this interesting conversation, Mr. Oluseyi Akinbi, Managing Director, Zedcap Partners Limited. We're discussing implications of the rising tide of inflation in Nigeria on the fixed income market. Thank you once again for the insights you shared.
Thank you. You're welcome.
That will be all for this edition of the Market Review Show. If you have questions or suggestions on our conversation today, talking about the implication of the rising tide of inflation in Nigeria on the fixed income market, please send an email to Ottoabasi.Abasiekong@proshare.co. It's displayed on the screen. Also, you can join our website, www.proshare.co, to read our latest news articles, stories, and reports around the capital market, particularly activities in the fixed income space. You can engage us via our social media platforms displayed on the screen. Particularly, we have for you an interesting infographic displayed on the screen now, talking about the drivers of inflation. If you want to see that infographic, you join us on our social media platforms displayed on the screen. Don't forget that you need to be informed to make the right investment decisions. Thank you for watching, and keep discussing the financial and capital markets, because they create wealth and economic opportunities.